next topic on our agenda is depreciation. In order to discuss depreciation, I need to explain a little more about the values assigned to all the balance sheet positions. So it's very simple, and I would even go so far as to say it's obvious which value you would assign to the position cash. At the end of the year, you would just open your cash register or look at your bank account, how much cash do you have there. If you find 100 euros, then you would put in 100 here. It's very simple. Just by counting, you can really figure that out. It's not as easy with all the other positions. Let's take the building, for example. In order to explain that, I have to introduce a new term. It's called historic costs. Historic cost means the value that you assign, in my example, to the position buildings is what you initially paid for acquiring it. So let's assume I bought an apartment for, let's say, 1,000. Yeah? Then the value would be, at least initially, be 1,000, because that is what I originally paid for it. Historic, because it's a value from, well, the past, obviously. Yeah? The question is, does this value stay the same during, well, the lifetime of the company? The answer is very simple, no. Because everybody knows that from his or her own experience. If you buy a car and you drive with it, of course the car loses value. You might purchase a car for 100 after driving this car for 5 years. I think it is common sense, everybody knows that the value of the car is very low then. Why is that? What is the reason for the decrease in the value, in my example of the car? Well, you use up parts of it. Yeah? The tires, the braking system, the engines. So by using it, you could even say you consume parts of it, and that has to be reflected somehow in the balance sheet. The question is, how can we do that, and how is it called? This is basically depreciation. So to give you a definition, what is depreciation? I would say depreciation is the loss of value of an asset because of, well, the use, because, well, time is moving on. How is that calculated then? The simplest version is the so-called straight line method. That is also the most common approach, and it's actually very simple. Let's take my example with a building. I initially bought it for 1,000, that is the purchase price, and that is the number that I initially put into the balance sheet. In order to calculate the depreciation, you need to know the useful life of an asset. Useful life means how long can you expect to use this asset? Well, until it is too old to be used, too crappy to be used, breaks down. Let's assume here in my example, the building has a useful life, let's say, of 10 years. What is the loss in value every year then? It's very simple to calculate. The depreciation would be the purchase price divided by the useful life. So in my example it would be 1,000. That is the price I originally paid, divided by the useful life of 10 years. So 1,000 divided by 10 equals a depreciation expense of 100 every year. What does this number mean? Well, it's relatively simple. It means the asset building loses in value 100 every year. So if this is the balance sheet of the first year, in year 2 I would expect to find here 900, in year 3 800, and so on. Yeah? Like I said, that is the simplest form, yet in my opinion the most important form. I'll show you one more thing. Building is a good example. Usually you use something not until the point where it completely falls apart and has a value of completely zero. Usually you use an asset until it is, well, until you don't want to use it anymore, but in real life you usually still can sell it. Not for a lot of money, that is of course a fact, but still usually you get something. That is what we call in finance residual value. Then the depreciation is calculated a little differently. Let's assume same building, purchase price still 1,000, but I intend to use it only for 5 years, and after 5 years my plan is to sell it. Of course I can, try to forecast housing prices, so I'm pretty confident that after I sell it I will still get 500 euros for it. So the residual value would be 500. How is the depreciation calculated then? Still very simple. Depreciation equals, same start again, 1,000 minus the residual value. Again, residual value means the money that you get at the end of the useful life if you sell it to somebody else, and then same as before, divided by useful life. So in my example it would be 1,000 minus 500 is 500, divided by 5 also equals 100. Again, what does it mean? The 100 depreciation expense means the decrease in value in the course of the useful life of the asset.